Okay, today we're going to talk about chapter 4. So basically, you guys can think about this is a class for June 14. So in the last two classes, we actually talk about chapter 3, where we learn how to do common size and how to do ratio analysis. And if you guys look at the slides and videos carefully, you will find that we actually did common size and ratio analysis on the historical financial statements. So when you say historical financial statements, we means what happened in the past. So all those statements are basically based on the activities of the past. But the most important thing in business is to think about tomorrow, the future. So in chapter 4, so we'll basically talk about or think about tomorrow, which in the language of finance we call financial planning. So in this class, we actually talk about how to do financial planning and how to do financial planning in terms of statements. That means we have to forecast financial statements for tomorrow, and we'll talk about some growth rates. So now when you talk about financial planning, it has a couple of components that we need to think about and that we need to forecast. The most important component, I should say, is one of the we have to think about sales. So the most important component we have to start with for financial planning of any business is actually sales. So we have to think about what should be our sales tomorrow. And if you have to think about what should be our sales tomorrow, we have to start with what is the sales today. And this difference is basically growth rate. So we have to think about how much we can grow in terms of sales from today to tomorrow. And to achieve this sales growth, sometimes we may need to invest in fixed assets. In finance, we call it capital budgeting decision. So if we invest in fixed assets, we need money, we need funds. How can we get the funds? We have finance. We can go for equity or we can go for debt. So that is called capital structure decisions. And then in this capital structure decision, there is the implied decision is like, we already generated some profit this year. Should we use it to grow in future? That means, should we keep the profit within the firm, which is, should we retain the earnings, or should we distribute the profit to the stockholders? That means, should we pay out dividends? So that means we have to think about dividend policy too. And also we have to think about what should be our liquidity requirement, like what should be our net working capital decision. Okay, so these are the 4 or 5 big decisions we're going to learn in these classes in chapter 4, so that we can do a good financial planning. So basically, most of the financial planning process could be short run, which is maybe for next 12 months, could be long run, which is could be 2 to 5 years. Okay, and to make those planning, we have to think about a lot of assumptions, like realistic assumptions, because we cannot say that in the last 10 years we make a progress of 5% sales growth each year. Next year we should achieve 20% sales growth. No, it doesn't make sense. So we have to be careful. We have to make realistic assumptions. And we have to talk about or think about different scenarios, like good, bad situations. Let's say if there's a natural disaster come next week, how should our business look like? If there's a recession coming next year, how should our business look like? So basically, in next week to next 5 years, if there's some bad situations coming up, could be natural disasters, could be recession, could be higher interest rate in the economy, could be something like that. What should be our situations? We can also think of the good side too. Let's say we're expecting the economy will be in a growth cycle in the next 5 years. How our business will be affected in a good way for this. So think about both a good and bad thing. So basically, the idea is we have to think about a normal case, we have to think about a worst case, and think about a best case. So now let's talk about in details what are the steps. So I think I already gave you some hints that the steps of financial planning or steps of thinking about tomorrow starts with sales forecast for tomorrow, which means when you say tomorrow, think about next year. So sales forecast for next year. So when you think about sales forecast for next year, you have to think about how much growth we can achieve or attain for next year. So this is the most important thing. Think about growth, how much growth we can attain. Can we attain 5%? Can we attain 6%? Can we attain 7%? So if we know our today's sale is $100 and we can attain 10% growth next year, that means our sales next year should be 110, right? 100 times 1.1, 110. So this is the most important questions we have to answer. If we can answer these questions, then the next steps are pretty easy, because if we know our next year growth is 10%, then we can also think about what should be the cost of goods sold, because we know that cost of goods sold are very linked to the sales, right? They're proportional, right? We know cost of goods sold. And then we can also figure it out, do we need additional asset to achieve this 10% growth, or we still have assets in place so that we can use those assets to achieve the growth? So we have to think about asset requirement. And by thinking about asset requirement, we can also have an idea how much the depreciation should be next year, because if we don't need more assets, we should not have a lot of depreciation, maybe. If we need more assets, we may have a lot of depreciation. So we have an idea how much depreciation could be, depending on should we need asset or not. If we need asset, where do we get the funds? Should we issue equity? Should we issue debt? So we have to think about that. And this decision is basically a management decision. And sometimes it is known as plug variable. So you can think about deciding debt versus equity. These two variables are plug variable. So what do we mean by plug variable? So basically, so far we know that we will start with forecasting sales, and then all the items or all the accounts in the income statements will increase or decrease accordingly, right? Based on the sales. And then we know that should we need more assets or not? Should we need more assets or not? After that, we have to think of financing, right? We have to think of financing, and management can decide, should you go for debt financing, equity financing? And this financing decision has to be consistent with these equations. Right? If we need more assets, we have to be careful. Liabilities and equity should grow accordingly so that this equation fulfills, or our balance sheet balance. Okay, so that's why management will think about these two factors consistently so that this equation matches our balance sheet balance. So that's what is called plug variable. We'll play with this variable to make sure balance sheet balance. Okay, so in a nutshell, our job is to think about sales and sales growth rate. Then we can forecast all the cost accordingly. And then we have to decide, do we need asset to attain this sales growth next year? And if we need assets, where will we get the financing? And management will decide the financing, act as a plug variable so that they can balance the balance sheet. Let's start with a very simple example, and I believe it will help you to understand what is the financial planning and how to balance the balance sheet. The most important thing is think about the sales growth and then also balance the balance sheet. Because if you don't balance the balance sheet, there's a wrong in the process. So let's say this is a corporation. So it's a coffee shop, okay? It's their 2018 financial statements. This is income statements, balance sheet, okay? So in 2018, they have a sales of $2,000, and they have a cost of $1,600. So you can say that cost is basically 80% of sales, right? 80% of 2,600, right? And you can say that net income is basically 20% of sales. Now, if you want to convert everything, even the balance sheet approach, balance sheet accounts too, in terms of sales, if you need to convert every account, balance sheet, income statement, everything in terms of sales, this is called percentage of sales approach for financial planning. So what is a percentage of sales approach? So percentage of sales approach. This approach says that if you want to make financial planning, if you want to forecast income statement and balance sheet, you have to convert initially everything in terms of sales. Convert all accounts in terms of sales. Right? First job. So we are basically converting all historical accounts, to be specific. So these are historical statements, historical accounts. Debt is 20% of sales. Equity is 30% of sales. Makes sense so far? Sorry, 50 should be 50%. If not, feel free to let me know. 50% of sales. So this is our first step. Second step, forecast sales growth. Next year, 10%, 15%, 20%. So let's say we decided next year sales will grow 15%. So 2000 times 1.15 is 2300. Okay. And then third step, forecast everything except plug variable. Forecast everything except plug variable as a percentage of, or you can say as a historical percentage of new sales. So the idea is we will use all the historical percentage relationship, and then for forecasting, we'll use the forecasted sales. So basically, our forecasted sales is 2300, and for cost, the historical percentage was 80%, okay? So 80% of 2300 is 1840. 20% of 2300 is 460. Make sense? 80% of new sales, 20% of new sales, except plug variable. So initially, what is the percentage of sales approach is trying to tell you? Initially, convert all historical accounts in terms of sales. Then forecast sales growth and find out the next year sales. And then use the historical percentage and forecast the new accounts, like all new accounts based on new sales. This is what you did here, except plug variable. If you come here, this is our plug variable, right? Plug variable, right? So we'll talk about this later, okay? Because management can decide how they want to play with these two, so that to balance the balance sheet. So now we know that historical percentage of asset was 50%, right? Historical percentage of asset was 50%. So new sales is 2300. 50% of 2300 is 1150. So asset is 1150. So liabilities and equity should be 1152, right? So management can do two things. Management can think about dividends of plug variable. That means they will adjust the dividend and they will let the debt not to adjust. Now, what does it mean? So basically, if they want to adjust dividend, okay, equity will increase at 15%. Dividends is the plug variable. So the equity will increase at 15%, okay? Why? Because sales is going to increase at 15%. Now our initial equity was $600. $600 times 1.15 is 690. So debt is the rest, which is 460, okay? Because they're trying to pay dividend. Now, if equity is 690, you have to be careful. Equity was 600 last year. Equity was 600 last year, equity becomes 690 this year. Company did not issue any new equity, That means this $90 is coming from addition to retained earnings, which is the company kept profit from the last year. So basically, the profit is $460, right? Equity increase from 600 to 690. No new equity issued. So 90 is increasing from retained earnings. So 90 is coming from this value. So that means 460 my net profit, 90 is addition to retained earnings. This is my dividend paid. Make sense? So they will adjust the dividend. They will pay dividend. Now, company can also decide. Company can also decide. Debt is the plug variable. And no dividends are paid. So they decided debt. So initially they decided dividends are plug variable and equity increases at 15%. That they decided. Now they decided debt is the plug variable and no dividends paid. So no dividend paid. So that means this entire 460 will be kept. Okay. Last year equity was 600. This 460 will be kept. 600 plus 460. 1060. And the rest, the difference going to be debt. So basically what the company is doing, company is basically using the $460 pay the debt. Makes sense? So what they did, they actually pay $310 in the debt. So let me know if you have any questions. So now if I want to give you a heads up again, so the refresher again. So debt is the plug variable, no dividends paid. So that means 460 will be kept. 600 was last year equity, 460 was new addition to equity. So 1060 is what? 1060 is basically new equity. So our asset, liability and equity should be 1150. So 1150 minus 1060 is $90 of debt. So that means last year debt was $400. This year debt became $90. So company actually uses addition to new equity, addition to retained earnings or new equity to pay back 310 amount of debt. And the rest 150 is used to purchase additional asset. So you can think about this new 460 is kept for new equity, and from 460, 310 is paid to reduce debt, and 150 is used to purchase new assets. So that's it. So I should recommend very slowly think about the process. So on the test, information will be given. So let's say on the test, this will be given. You can calculate historical percentage. Growth rate will be given so that you can forecast next year revenue and calculate this. And then it will be told what company wants to do, like this or like that. And then you have to decide. Because I have to give you some more recap. Company decided 15% growth in equity and the rest of net income is basically going to use to pay dividend. So that's why they paid $370 dividend and 90 increase in the equity. So that 90 is used to purchase assets, but asset is increased by 150, so 60 more than the equity. So that means 60 additional debt is coming to finance the asset. So 60 additional coming from debt to finance the asset, 90 additional coming from equity to finance the asset. This is this situation. Case 2, they decided debt is the plug variable, no dividends are paid. So 460 will be kept as a new equity. From that, 310 is used to pay the debt, and 150 is used to purchase the asset. That's it. So just I understand the process. Now, one of the important assumptions of percentage of sales approach. All historical accounts convert in terms of sales, and then when you are making the forecast, in the forecasted statements, all accounts will vary in terms of sales. This assumption is not correct. There are some problems with that assumptions. So let's go one by one why there is a problem of that assumptions. So this page is trying to talk about that so far what we made the assumption is all will vary with sales, but this is not true. Some items will vary with sales, some will not. And this is the problems. This is the problem. So you can think about this slide. What is the problems of percentage of sales approach? Because percentage of sales approach explains you all vary with sales, which is not true. We're going to learn it. In general, cost of goods sold vary with sales, because if you produce more goods, you need more labor, more raw materials. It makes sense. Okay, cost of goods sold vary with sales. But depreciation in general do not vary with sales. Do not. Because sometimes you already purchased the assets, but you are not using the 100% capacity. Okay, so you can think about, I purchased the asset, I'm using some capacity, and depreciation should vary with sales. That kind of makes sense. But if you think very carefully, sometimes you are not using the 100% of capacity, maybe using 70% of capacity, and rest 30% is idle. And due to just putting the asset idle, there is an warranty here. So depreciation may not 100% vary with sales, but there is a good relationship that depreciation will partly vary with sales. Okay. Interest expense definitely not vary with sales. Why? Because corporations can decide all new financing is coming from equity. Corporations can decide all new financing coming from debt. And because of that decision, the relationship between interest expense and sales will be affected. Because if corporation decide all new financing is coming from equity, so that means even if sales is growing up next year, interest expense will not grow up, because new financing is coming from equity. Interest expense will be fixed like history, like before. That's it. Because we're going to talk about in details in few classes. So the idea is when you borrow any loans or debts or something like that, there's a fixed interest against it. Okay. And now for additional financing, if you don't borrow, if you just use your own equity, that fixed interest expense will be constant forever, or at least for a couple of years until you borrow more. So that's why if you think if sales grow up next year, interest expense will grow up next year, that doesn't make sense, because all this new financing is coming from equity. Equity doesn't have an interest. So that's why interest expense may not vary with sales. So if you think percentage of sales approach told me interest expense will vary with sales, this is not correct. This is a problem. Similarly, dividends and management decisions. Company can decide pay everything this year, company can decide pay 50% next year, company can decide not to pay anything in the year 2. So this doesn't vary with sales. Again, continuing problems of percentage of sales approach. So we assume that all assets vary with sales. That may not be true. Okay, that may not be true, because sometimes fixed assets, depending on if you need more or not, it may not vary with sales. Because let's say right now you're using 70% capacity of your fixed assets. You're expecting some growth next year, which you can generate by using the rest of the capacity. So you may not to invest in the fixed assets, but your current asset may vary with sales. Why? Because if you generate more sales, you may need to hold more inventory. If you generate more sales, you may need to have more accounts receivable because you're selling a lot of items in credit. So those are varying with sales. And sometimes it is recommended you maintain cash as compared to sales. So current assets is definitely could vary with sales, but fixed asset may not, depending on at what capacity business is running right now. Accounts payable normally vary with sales. The reason is the same like current asset, because if you can generate more sales, you need more inventory, more raw materials, and there is a probability that you will buy them in credit. And if you buy your raw materials in credit, account payable will go up if sales go up. So accounts payable and all those current assets, they vary with sales. It's a good decision, realistic assumptions, because those are linked to sales in the process of generating from raw material to finished products. And all those financing decision, this is management decision. Financing decision, dividend payments are management decisions. And because of dividend payments, addition to return earnings or change in return earnings is also a management decision. So you cannot say that this is a fixed with sales. So these are some problems, okay? So I'm repeating. Percentage of sales approach will tell you all accounts value with sales. When you're making forecast, use the historical relationship with sales. But this is not true. There are problems because financing decision, management decision, they can decide more equity, more debt for additional financing. That's going to affect interest expense. And also management decide how much dividend to pay, how much to keep within the fund from net profit. So that's going to also affect your dividend policy, return earning policy. Depreciation, depending on what capacity the firm is operating, depreciation could vary with sales, could not vary with sales. Fixed asset also depending on the capacity could vary with sales, could not vary with sales. So some things could, something should not vary with sales, and there are something they should vary with sales. So mix and match, okay? If you have any questions, feel free to let me know. So now we're gonna look at a little complex example of what we did here, okay? What we did here. Now let's say this is the income statement, this is the historical side, okay? Historical side. So last year sales was 5,000, cost was 3,500. So you can say cost was 70% of sales. Earnings before profit is 30% of sales. Tax was 6.3% of sales. Net income was 23.7% of sales. Okay. And dividend payout was 40%. So payout was 40%. That means 40% of net income. Okay. And 60% was retained earnings because they should sum to 100%. So now we are making a sales growth assumption of 10%. So 10% of 5,000 is 500. So right now we're making 5,000 of sales, 10% growth, we will be making 5,500 of sales. This should be 70% of new sales, 6.3% of new sales, 40% of new net income, 60% of new net income. So this is how we should project the income statement. So this will be given, no worries. Now from that, we know that, let's say asset will vary accordingly. So if you look, this is the historical asset, okay? So in the past, asset was 5,000 sales. Asset was 220% of sales, okay? Total asset was 220% of sales. So now we're doing the same thing, 220% of new sales. 220% of new sales. We know that accounts payable will vary accordingly. So 18% was historical relationship, 18% of new sales. This is a financing decision, plug variable, financing decision, plug variable, financing decision, plug variable, but 3,100 was last year return earnings. Company decided 782 will be addition. 3,100 plus 782 is 3,882. So this one, and this one, these three are plug variable of management decision. Now, if we assume those plug variable are as is, like last year, no changes, you can see that our balance sheet do not balance. Why our balance sheet do not balance? Because we have less liabilities and equities than assets. Now management has to decide because management need more assets than their capital, debt and equity. So management has to decide what the management should do. So basically management has $278 more of asset than capital, debt and equity. So management has to make a capital structure decisions. Management can decide borrow short term, which is notes payable. So increase this one by $278, or management can decide borrow long term, which is this one. So only increase this one by $278, or sell more stock or borrow through stock. So only invest on this one by $278. Management can also decide reduce dividend. Although historically their dividend payout ratio was 40%, management can also decide, let's reduce dividends. This year we are not going to make 40% payout. So let's reduce this by 278 so that these add by 278. As a result, this value increase by 278 more and our balance sheet balance. Management can also think about a mix. Makes sense? Management can also think about a mix, like let's say increase long-term debt by $100. Let's say short-term debt increase by $78, and let's say common stock increase by $100. So all together $278 of increase. So they can decide a mix because they have to increase debt liquidity to balance the balance sheet. Things could be different too. Okay, things could be different too. Now let's say this side is less. Let's say this side is less. Now what the management should do? Management can do the opposite. They can reduce some short-term liabilities, they can reduce some long-term liabilities, or they can pay more dividends to reduce the addition to return earnings so that they can balance the balance sheet. Okay, so there are so many different ways management can do so. So this is so far for this class, June 14. We are in the middle of chapter 4. So in the next class, we'll talk about chapter 4, rest of the chapter 4 and finish that up. Thank you.